highlighting the importance of this chart is that global steel excess capacity remains a big concern for Canadian steel producers and is playing a role in steel trade and distortions in the market. If you look at 2019 and 2020, you will see that capacity increase in the world compared to demand. And the OECD and World Steel analysis does mention that steel overcapacity is about 640 million metric tons. If you do a quick calculation, that is about 40 times the size of the Canadian market. And why I'm bringing this up is despite our production levels in Canada being lower and production numbers remaining steady or increasing in some parts of the world, that steel that is we call excess capacity needs to find a home.
But when you remove your default risks, your debt costs are going to go down. When you remove your volatility of returns, your equity valuation multiple, all else equal, should go up. So basically, you should think of price risk as a form of leverage on your business. And really, it's very similar. If you have a lot of debt, it can turbocharge your returns, but at the same time, it raises your risk of default. Well, if you have a lot of price risk, it also raises your risk of default. The difference is, unlike leverage, which you can actually invest and make money off of, you can't make money off your price risk through cycle. The nature of it is, if things are generally fairly valued, you're going to make money half the time and lose money half the time. So to apply basic business school principles, and this is something people tend to get this analogy. If you have one stock that returns 10% with volatility of 20% and another stock that returns 10% with volatility of 10%, you'd rather own the second stock. And the reason for that is you can lever that at 2 to 1, have 20% volatility and double your returns. Or you can maintain half the risk with the same return profile. So when you hedge, you're basically turning yourself from stock A to stock B.
For the last couple of years, net imports have been down a dramatic amount following the Section 232. We believe net imports last year fell about 30%, which did give share gains to the U.S. producers, despite the fact that demand was off. They still gained on a net basis. This year, we think the table's turning on imports. We think on a net basis, imports are going to grow over 20% this year, largely just related to the need for folks to get materials in, and the fact that imports often are directionally linked to demand. So we think sheet, plate, energy products are really where you'll see it. We think there's going to be a wave of sheet imports that comes in the middle of the year, largely spurred by the arbitrage in the U.S. market that was really opened up in the first quarter.
Let's go to your board and work with your senior leaders and just ask the question, what does risk mean to the enterprise, right? And how do you define that? Some companies define risk as simply, the deviation from an expectation. Others might say, look, any event or occurrence that can torpedo our strategic goals and throw us completely off track, the likelihood of that happening, that's a risk, right? So again, taking this all in the context of metals price risk and what that means to our business, okay? And not just thinking about what that risk is, but the timing of it, getting a real appreciation for the cyclicality of our business or the seasonality of it, right? And considering, environmental issues, geopolitical issues as well. And then of course, materiality matters, right? If we think about risk as sort of the confluence of impact and probability, things that have a high probability of occurring that could be detrimental to our business, saying a key supplier going down that we're buying sheet from, but if it's a low impact because maybe they're not a huge supplier of ours, that's probably not going to be as a high risk as saying, okay, maybe the probability is kind of medium, but a huge impact to our bottom line. Taking these things into context is obviously crucial, and not every risk is equal, right? So taking that criteria into the equation as well.
One thing to keep in mind and to look at is with these high prices of steel, when do they start softening? Well, one of the definite things you need to look at is how are lead times? I currently truly believe the lead times are being a little overinflated. We're definitely seeing hot rolled coil availability still in July. We're seeing cold rolled coil availability still available in the United States in July. Those are significantly lower lead times than what some are reporting. So lead times is the key, and we're definitely starting to see a little softening. The mills have definitely caught up. They're releasing some spot tons in the market for sale, especially with these high prices. And with the significant amount of imports inbound, we're going to definitely start to see, potentially in July, where we kind of peak out in price.
But when it comes to hedging strategies, the diplomatic answer is we've seen it a ton of different ways, but that's not a great answer, so I'll give a few examples. One is, we're working with the Steel Service Center, and they're as concerned with volatility in inputs as they are with outputs. So for them, it's incredibly important to maintain a certain margin. So for them, kind of vanilla, long and short futures hedging strategy and HRC is what they've chosen to employ. So they're hedging HRC in the purchase side, using long futures, and then they're shorting futures on the sales side. Of course, I'm oversimplifying this because timing is everything, and they've got really good bench strength on the trading and hedging side, right? But that is the strategy that they have chosen to help lock in that margin. So, net, they're mitigating risk and ensuring profitability. So that's their approach.